Today's presentation is going to focus on valuing stocks, both value stocks and growth stocks, and I can assure you that it's not going to be a boring regurgitation of what a price-to-earnings ratio is, though we'll cover that. It's going to be kept very accessible and simple because we're simple people. Now, I wanted to start out with this great Dilbert cartoon where somebody is complaining to their boss that the investment advice that they were given lost them their savings in the stock market. And the boss says, well, investment advice only works for the people that give it. And that's absolutely true. So we don't give investment advice. We simply focus on helping people become better investors. Now, if you do me a favor, there's a red subscribe icon. You see that in the lower corner of the screen. Please click that and subscribe to our channel. By subscribing, you're helping to support our efforts. So I wanted to start today out with a question. Oftentimes, this manifests itself when somebody wins the lottery, and there's usually a choice between a lump sum of money or receiving a smaller amount over a period of time. So the choice we've provided today is, do you want to receive $16,000 now or $1,000 a year for the next 20 years. Now, just a cursory look at that, you might think, well, I'll take the second option because that represents $4,000 worth of more of money. There's this notion, of course, this old adage, a bird in the hand is better than two in the bush. That would imply that taking the money today makes sure that there's no danger of not receiving it in the future. So let's just assume this is guaranteed and that there's no delivery risk. So what information do we need to solve this problem? Well, there's a very important concept they teach you in B school that I want to talk about. That's the time value of money. And there's two ways to think about it. Investopedia lists one right here. So the concept is that a sum of money today is worth more now than the same sum in the future because you can take that money today and earn interest on it. So it's worth more today than if you received it down the road. That's one way to think about it, but we'll give you two things to consider, okay? The second is that inflation erodes the value of money over time. The best way to think about this would be if you were a retiree receiving Social Security, a fixed amount of money every month. After 10 years, after 20 years, inflation will bring costs up and your purchasing power will go down. So having money today not only represents the ability to realize interest on that money, but it also removes that inflation element. So for practical purposes, we've given an example here. Let's say you could realize 3% interest and inflation was 5%. You'd be losing money, right? But let's just assume this evens out. Let's assume that inflation's at 3% and interest rates at 3%. And let's stick with this idea of money losing its value over time. And here I've put together a spreadsheet that every MBA will have put out hundreds of these, and it shows the value of money decreasing over time based on inflation. In the first row, I've done the calculation at 3%, and the second at 7%, and this is done over a period of 20 years. And you can see that in the year 2042, the $1,000 a month at 3% inflation is now $553. So you could see you've lost about half your purchasing capabilities or purchasing power, as they say. In the case of 7% inflation, look at how bad that is. You're at a quarter, nearly a quarter of your purchasing power. So that's the erosion of fixed income over time. So we go back to solving the lottery problem. The value of that money today is $16,000. That's what we're going to give you. But if you took that money over the next 20 years at 3% inflation, it would be under $16,000, just under. And at 7%, it would be under $12,000. So even though you're promised $20,000 over 20 years, what you actually get is a lot less because of the time value of money that's eroded. So guess what we've just done? We've valued an asset. So if you can imagine a magical box that sits on the counter and spits out $1,000 a year for 20 years, what would that box be worth? Well, we've figured that out. And another word for that asset would be an annuity. And again, you see here the importance of being able to guess what inflation is and how inflation can impact the value of assets. Now, I wanted to quickly plug an investment strategy that we built simply because we didn't want to be in the situation of being retired and having our quality of life decrease over time, as is the case when most financial advisors advise that you have fixed income and Social Security, so you have a fixed amount of money coming from retirement all the way until you die. Let's say that's 20 or 30 years. As we saw earlier, with just even moderate inflation, your value, your quality of life is going down significantly. So we built this dividend growth investing strategy. It acts like a bond and pays like a stock. It's recession proof, very easy to understand. 90% of the long-term performance comes from dividends. It beats inflation and beats the market. Over the last 10 years, the average increase of a dividend out of the 30 stocks that we're holding was 7.8%. That handily beat inflation. Now, maybe now that's not the case because inflation is going up, but you can see how well that works. So let's talk about some more magical boxes. So really, a company is a magical box that produces money. So the money that they bring in is revenue, right? That's all the money they receive. Cost of goods sold is what it costs to produce that revenue. And then profits are what's left after they pay all their overheads. So you could think about a company that generates profits, what's the value of that entity? And when we look at valuing companies, there's two types. There's growth companies that promise potential value in the future. And then there's value companies where the potential has been realized as a known quantity. And of course, the investment community will define growth and value very differently, but I wanted to use those very simple definitions. So let's talk about the most common valuation method that you'll come across, which is price to earnings ratio. And it's the price of a stock and the earnings per share. So you figure out earnings per share. In this example, they've taken earnings over the previous 12 months, divided that by the number of shares outstanding. So that's the earnings per share, what it says on the tin, really. And then you take the share price and you divide that by earnings per share. So that share is really a slice of the company. So let's think this through logically. A share represents a slice of ownership of that magical box. Each share gives the owner earnings per share, what it says on the tin. Just for a single share, the earnings per share is what the money that stock receives on a quarterly basis. So you might have other questions. How consistent is the earnings per share? Is that earnings per share growing? That's what analysts look like. So a percentage of earnings per share can also be given to the shareholder as a dividend, or it can be plowed back into the company. But let's not get into that technicality. Let's simply keep it at earnings per share and say that's the profit the magical box has produced. And at $100 per share, if it's producing $5 in earnings per year, you can see that stock is going to be more rich than a share that produces $10 in earnings per year. In the first example, that would be what? A P&E of 20. In the second, a P&E of 10. So that's a very simple example of how price to earnings ratios work. We don't use them. A lot of people do. We choose not to use them, and that's because the portfolios that we're managing, we manage two. One is dividend growth investing, that's value stocks, and here you can see the approach that we take. And in this example, we're looking at all dividend champions in the materials sector. We're looking at 7 factors: years increasing dividends, market cap, yield, payout ratio, international sales, and of course the dividend growth. And the resulting Q score we then use to rank these stocks, and then we make decisions based on these Q scores and other things. But we typically don't even pay attention to price to earnings ratios. Another way that we'll watch the valuation of a stock over time, some investors will, is by looking at the change in yield. So the example here for VF Corporation, you can see that their yield has spiked dramatically recently, over 6%. We actually did a video on that, and I'll link to that in the description of this video. And you can see that spike there. Why is that? Well, commonly, it's because investors start to question whether or not this company will be able to keep increasing their dividends or even sustaining that dividend with a minimal increase. And you can see that in the oil sector, or at least you would have seen that before with Exxon and Chevron. The situation has changed dramatically in the time of coronavirus. The price of oil actually went negative, and those companies were hurting, and now it's a different story. Below that, you can see J&J. So you'll hear a lot of investors say, I'm not going to invest in J&J unless they have a yield of 4%. You'll never see that. And you can see here in this example, the charted yield of J&J over time. The best you might have realized there would be what? About 3.5%. So this is another way that income investors will look at stocks to see how they're valued relative to the yield, the dividend yield that they're kicking off. So let's talk about valuing growth stocks, because this is an entirely different animal. Growth stocks have to have revenue growth by definition, right? They're growth stocks. Most growth stocks are losing money. They're not generating a profit. So how can we value an asset that doesn't generate profits? Well, we focus on revenue growth. So in the world of disruptive tech investing, we find technologies, powerful technologies that are used to create a product or service that can address a very large opportunity, what's called a total addressable market, or TAM. Two types. One is blue ocean. That means that you're not competing against an existing solution. It's brand new. The other would be where you're displacing an existing product or service. Clearly, the former is better, right? Because there's fewer competitors. So revenue is a proxy for market share being captured. That's why we focus so heavily on revenue growth. We want to see them dominate, especially leaders. We always look to invest in leaders. So a simple way to value growth stocks, since they don't have profits, right, that we can't use price to earnings ratio, is to look at price to sales ratio, or price to revenue, commonly referred to as price to sales ratio. You can see here where that's been simply calculated. We take the market capitalization, the value of that entire company, and we divide it by revenue. Very simple stuff. Now, the revenue that you can take, I've used this example from Key Investment Partners for cannabis stocks. It's quite good. If you look at the two highlighted cells at the top there, you'll see price to sales calculated for 2021 and 2022. See how it's decreasing over time. Then compare that to price to sales for alcohol and tobacco firms. Below, you see nice and consistent, right? 3.8 average from year to year there. And what they've done here is just a relative comparison to show that MSOs, multi-state operators selling cannabis essentially, are growing very strongly whilst alcohol and tobacco firms aren't, yet they're undervalued relative to alcohol and tobacco companies. Now, we've taken price to sales and tweaked it. Our own ratio that we use is called a simple valuation ratio, SVR, and we simply take market cap, divide that by the last quarter revenues times 4, what they would call annualized, right? You annualize the number. You multiply last quarter's revenues by 4. That provides us with a lot better responsiveness than waiting until the end of a year, perhaps using a rolling yearly value. We get a lot more responsiveness for that, and it works particularly well for companies that are growing fast and consistently over time, SaaS firms in particular. Doesn't work so well for companies with sporadic revenues like gene editing firms. Some people have asked why we don't use enterprise value, and I'm not going to get into that. The simple reason is that we want any retail investor to go to Yahoo Finance, take a look at the market cap number that's sitting right there up at the top, go to the lower right, take a look at the quarterly revenue number, and do the math very simply. Let's keep everything simple. So let's think this through again. Market cap is the value of that magical box. Revenue represents the market share the magical box is capturing. So that ratio represents how much we're paying for market share being captured in a particular domain. So the lower the valuation number, the better. That means we're not paying a rich valuation. When revenue increases and the price stays the same, then the ratio will drop. That's good, right? We want to buy stocks cheaper. We want to pay the best price possible that we can for a stock. When revenue stays the same and the price increases, that brings the ratio up. That's bad, right? Because we want that ratio to be as low as possible. So this works really well over time as the price of a stock changes and the revenue keeps increasing. It really provides you with a way to set targets. Now, we want to think a little bit beyond market share captured towards survivability. So it's not just about revenue growth. You look at a firm like Fluence, and they have very, very tight gross margins. I think last year they didn't even have positive gross margins. You can't produce a good and then sell it for less than it costs to produce. That doesn't work. So gross margin tells you how profitable will this business be in the future. We also look at runway. That's cash on hand divided by their burn rate. And the question you're answering there, do they have enough cash to survive without having to dilute shareholders or take on additional debt? So here we've calculated the simple valuation ratio for a number of stocks. We have a tech stock catalog that contains 460 stocks in a Excel spreadsheet with tons of data points. One of those is the simple valuation ratio. You can see here these numbers are rather old, so most are the second quarter of 2022. We have an intern that will go through and update these. We'll probably do that pretty soon here, but you can see these values, and I've highlighted Snowflake. We have a rule that says we're not going to pay more than a simple valuation ratio of 20 for Snowflake. Does that number really matter? No. What's important is that you have a number and that you use these targets so that you can see what you're purchasing a company for relative to other firms. So for example, in the bull market, we had a rule that said we weren't going to pay a simple valuation ratio over 40. And like when C3 went public, I think it was around 70 or 80. And a lot of these firms were above 100. And we had set that rule. Now that the market is correcting, we've lowered that and said, look, we really want to buy firms at good prices because we think that the bear market will be sustained for a while, so we won't buy anything over 20. Snowflake has always been one of the richest firms in our catalog. So this is just an example of how you can set a simple valuation ratio goal and then how it's responsive to Snowflake's latest and greatest earnings report. So just to conclude, pick a method of valuing stocks that's intuitive and that makes sense to you. That's what's most important. Use your method to establish rules to make sure you're not overpaying and you're extracting the emotion from your investment activities, and then modify your targets to accommodate market conditions and stick to your rules. So on this slide here, you'll see a Nanalyze logo. Please click that and subscribe to our channel. And then here I've put up a video that you might find interesting. It's about VF Corporation and their attractive 6% yield, and we dig into why that is. Thank you very much for taking the time to watch this today.